exposing false deflationary propaganda. Martin North, John Adams, in the interest of the people. Hello, John.
Hello, sir.
You're going to throw an interesting curveball into the discussion tonight. I just know it.
Yes. So we have something to clear up for our audience. Unfortunately, Martin, you've created a international monster on YouTube, and it is actually a very serious situation that has occurred because over the last few months on Walk the World, you have interviewed a financial advisor, Steve Van Metre, and Steve has made a very specific claim about quantitative easing and that QE is deflationary. And I've received a number of emails and social media messages from people who have watched Steve Van Metre on your channel, but he's also been on a whole host of other channels. Now, it's interesting that when he appeared on your, I think, most recent program on Walk the World, he actually credited you of the first interview he did with you was his gateway to a whole host of other international interviews that has now made him quite famous.
It's the DFA effect, John.
Yes. So that could potentially be the case. But on a serious point, so Steve Van Metre, after being on your show, he's gone on Real Vision Finance. He's gone on George Gammon's show, which is very popular. He's got a number of other channels, and he's made this very specific claim that QE is deflationary. Now, the reason why I took a lot of exception to it because this is completely, in opposition to what I've been writing about for a number of years, and also what we've been communicating on this show as well as on Walk the World in 2018. And so when I first heard Steve on your show talking about QE is not asset purchases but asset swapping, and that it has a deflationary effect, initially I thought to myself, well, if he's right, then I'm wrong. And if I'm wrong, I've misled our audience for a number of years, and I take a lot of seriousness to ensure that I don't mislead people, and I try to do the most accurate analysis I can. And with all of my published work, it's all freely available on my website, and people can read my analysis and obviously hold me to account about whether I've said something right or wrong. So when I started to hear Steve on your channel, this got me very intrigued because this is an argument I've never heard before. And then I started to listen to Steve on his own YouTube channel, but then some of these other interviews where he goes into, he has a very specific technical argument as to why QE is deflationary, and I've never heard this before until I was exposed to him. And to be honest, I'm glad that I was exposed to him because it forced me to actually investigate and actually do some research and obviously contact in the Australian context the Reserve Bank of Australia and look at some of the RBA applications. And what I have come away from my investigation is that the Van Metre thesis is false. That it doesn't actually hold water in the Australian context, and as we will get through this show, it doesn't hold in the American context either. Particularly because people have asked me about it, I think it's important that we correct the record and reassure our audience that when people watch in the interest of the people, we haven't so far, to the best of my knowledge, said something that has been demonstrably false.
And just to be clear on a couple of things. The first is that the very specific point we're going to explore today is not in some way debunking deflation as an potential outcome overall. In fact, on the last show, you actually made the point that if we don't get a lot of continued stimulus from the central bank, it will be deflationary.
Yes.
Right? So there are lots of other elements to the whole deflationary inflation future debate.
Yes.
Right? But this is a very specific point, which is actually quite technical at one level, but also very important at another level.
Because of copyright, we can't play some of Steve's interviews where he's gone into some detail. Now, there is one particular interview on Real Vision Finance that he gave with Brent Johnson from San Diego Capital on the 23rd of September. Now that has, as of we speak to today, it has more than 300,000 views. And this argument that QE is deflationary, I mean, both Brent Johnson and Steve Van Metre agree that it is, and they spend a 15-20 minutes explaining the reason why. And so if anyone wants to go through, so we'll go through the summary of the Van Metre thesis, but if people want to hear Steve in his own words, that's actually a very good interview to explore, and maybe we'll actually put a link to Steve's interview in the notes, and people can review his argument, and obviously I'll explain why that is. Now, in the last few weeks, Martin, I have gone to the effort of writing a 3,500 word article about the Van Metre thesis, and I've published my analysis of it. And that's on my website, and the article is called "The Fallacy of the Van Metre QE Deflationary Thesis," and that gives the full account of what Steve has said and my reaction, and also what I've included in there is information from the Reserve Bank of Australia, because it's important that when you interviewed Steve on the 4th of August, and this was his second interview with you, Steve said that he had received quite a few emails after his first interview, and Steve at that point he said that he's been telling Australians that this QE deflationary thesis holds true for Australia as well as the United States. And then that's when I had a number of Australians contact me. And so what my article goes into some detail is the official position of the RBA, and the RBA's position has been clear for about a decade about the intent of QE and how does QE work at a technical level. And so people can actually read my work and obviously send me any emails to the correspondence if they want to follow up on any technical points. There's a whole host of voices in this whole debate, from the Peter Schiffs to the Harry Dents to the Jim Rogers to the Lynette Zangs, myself, you, etc. And obviously people are doing their own homework, listening to a whole bunch of people's analysis and allocating capital based on what they think is going to transpire. And I just hope that no one has actually made any financial decisions based on this deflationary QE thesis, because if you have, you may have misallocated capital.
Well, on this particular point, yes.
Yes.
But the broader deflationary question still remains, right? This does not destroy deflation as a potential outcome.
No.
Right? So just be clear on that, right? So in terms of trying to build a position and to understand what's going on, you get information from all sorts of different sources and you try and make your own decisions. The important point to make is that your perspective would be that what Steve indicated as a way that QE works is not necessarily the way that it actually works.
Correct.
Right.
Yes.
Just to want to clear that up.
Yes. Now, so why don't we actually go into the Van Metre thesis?
Yep.
So basically, what he said on your show was that QE was deflationary, and that it was asset swapping and not asset purchasing. So he gave a very technical explanation as to what actually happened. So basically, what he says is that the U.S. Federal Reserve comes up with money. It goes out to the secondary market, and then it buys bonds, and those and the way it pays for the bonds is they put money in reserve accounts, which are accounts that the commercial banks have at the U.S. Federal Reserve.
So just to be clear, they buy bonds from whom?
The commercial banks.
That's really, really important.
Yes. So the central bank buys from the commercial banks, and the way they pay for the bonds is they put money in these reserve accounts. Now, the argument that Steve had said on multiple occasions is that the commercial banks cannot withdraw this money out of the reserves, and therefore, on a net basis, liquidity in the financial system was actually going down, not up. And because of that, that's how you get deflation, because there's less liquidity, there's less money sloshing around in the economy, in the financial markets, and it's being drained into this reserve account through this quantitative easing process, and that's what's causing the QE. So when I first heard this, I thought to myself, well, to be honest, it's not something that I actually paid a lot of attention to in terms of, well, how does that transaction occur between a central bank and the commercial banks, and are there any restrictions around what the commercial banks can do with the money they are paid by their central bank?
It is quite complicated, but it's also quite simple, because there are accounts at the central bank which actually reflect the balances of the commercial banks, right? And so there is a swap that goes on, but it doesn't actually suck stuff out of the system on a net basis. That's the key point, isn't it?
Yes, and the reason why it doesn't suck anything out is because the evidence that I've been able to find is that when a central bank puts money into an account for a commercial bank, the commercial bank can actually use that money and push it back into the economy, and therefore on a net basis, the amount of money sloshing around in the economy actually goes up.
Right.
It doesn't go down.
Except that the banks may then not be issuing bonds elsewhere or using bonds, so that they might not necessarily increase the overall liquidity in their holdings, right? It changes the mix within the holdings, but it does give them the ability to be able to lend more if that's what they want to do. And of course, that's what quantitative easing is trying to do. It's trying to get the banks to lend more.
That may not be the case. So remember, the purpose of quantitative easing is when the central bank buys government bonds to push the prices up and to push the interest rates down. Now, the question is, who benefits from the low interest cost? Now, you may say it's for the banks. Others may say it's actually for the sovereign government. So if a government pays less on its debt, well, then it can actually expand fiscal policy in terms of the deficit. And so while there may be some benefit to the commercial banks, I've always thought quantitative easing as a policy tool to help stimulate government to increase the deficit at a cheaper interest cost, rather than it actually is designed to encourage commercial banks to lend more into the private sector.
No, I think it's connected, you see, because if you look at what's happening at the moment, the costs to the banks of the funds that they're going to lend is being driven down for that very reason, because the rates are actually up, because the yield curve is lower. That means that they basically have access to cheaper funds than they had previously, which means they don't need to access more expensive funds from other sources. So it changes the funding mix, right? But the banks still have a choice as to whether they lend or whether they don't lend.
Yes.
Right? If they don't lend, then it sits in their accounts, as it were, but is not actually actively productive in the economy.
Sure. So your point is, do the commercial banks get a benefit out of quantitative easing? Look, so they do.
Well, it's also the economy. Does the economy get the benefit from quantitative easing? Because the whole argument about inflation is, well, all this money floods in, and everyone's lending more, and therefore there's more stuff going around, and therefore there's more money chasing the goods, and therefore inflation goes up. That's the argument, right? It doesn't work if, in fact, nobody wants to borrow.
The key point I want to make on this is, the commercial banks do get a residual benefit from quantitative easing, but to my mind, the primary purpose of QE is not to help the banks; it's actually to make it cheaper for government to spend more money. So this is part of the Keynesian fiscal policy package, as opposed to a specific tool to drive private sector credit growth. Okay,
well, you and I might have a different view of the relative importance of those two things. Looking at what the Reserve Bank here has done and what the Reserve Bank in New Zealand has done, other banks around the world, a lot of it's all to do with pushing more credit out there to try and create more momentum in the economy.
Well, we will have to agree to disagree on that point.
Fair enough.
In terms of what's the primary purpose in terms of quantitative easing. I mean, dare I say, if you look at past hyperinflation episodes where a central bank has printed money to buy government bonds, it has always been to help finance the government spending. So Zimbabwe, for example, even Venezuela, in terms of even I'm not sure about Argentina, but in some of these countries where you see runaway inflation, where the central bank has bought the bonds, it's to help the government finance the deficit. So again, so you may say in post GFC environment there was a different policy intent. If you look more broader in terms of a historical perspective, the primary purpose of buying these bonds has always been to finance, to be able to spur on financing government debt. And obviously there has been precedents where quantitative easing has been used during wartime to help governments finance a war effort. A couple of additional points to make. Now, one of the things that Steve Van Metre has said on previous occasions is that because the money is trapped in these reserve accounts and then it can never get out, he has said that basically the Federal Reserve is technically not really paying for them. It is this sort of asset swap. But one of the important points that he did make in this Real Vision Finance interview with Brent Johnson is he said that if the money could get out of these reserve accounts, then it would be inflationary. And so if people could read my article, I actually say in my article, this is the specific time, the specific minute and second point where he actually concedes that if the money is trapped in these reserve accounts, liquidity is draining down, deflation. If the money can get out somehow, then it's inflation.
But that's the point. If it can get out somehow, right, which is lending or it's buying bonds or whatever it is, right?
Yes.
That could then be inflation. But you need people to take the credit. You need people to be able to actually issue the bonds for that to happen, right? And if you are in a situation where, for example, consumers and businesses are actually very worried and they've got low levels of confidence, they'll be less likely to borrow rather than not. So you might not be able to lend. And indeed, it could also be the case that you've got all of these zombie companies issuing bonds, but those zombie companies in turn are unable to trade and therefore aren't creating more value in their own right. So you could see situations where that funding flows, but doesn't actually create the inflation that everyone's aspiring to.
The key concession that Steve made is that basically you've got a lockbox, and if the money can never get out of that lockbox back into the economy, depending on, again, it depends where it goes into the economy.
Exactly, that's the point. That's the point.
But he did say if it does get it back into the economy, this is going to be more inflationary than deflationary. Now, one of the things that I did as part of my research is I actually emailed Steve Van Metre using an anonymous email, and I just asked, can you provide me the evidence, whether it's a federal law, a regulation, a guidance, some sort of rule by the US Federal Reserve, where it's on the public record that says the banks cannot touch this money. Now, I got an email back saying that he couldn't provide me with that evidence. What he did say was that there were contracts between the Federal Reserve and the commercial banks, which were not public, that he had heard through industry sources that gave him the impression that the money couldn't leave these reserve accounts. Now, I've showed you that email. So we pride ourselves on trying to present evidence to this audience. So when I ask a question, show me how this this money can't leave the account, I didn't see any sufficient evidence that proved the point. And would you like to make a comment on that?
Well, I agree. I don't think there is any evidence.
Oh, good. So we agree on that.
Yeah, absolutely. Yes.
Okay.
Because I actually don't think that, and it goes back to this question. We're looking at it quite narrowly. The specific question of whether the money is locked in because of this particular bilateral agreement or not, for me, is a sideshow. It's not actually the main discussion in a deflationary context, right? For the reasons I articulated earlier on.
Sure. Now, so we've talked about the Van Metre thesis, which I've said, I emailed him and using anonymous email, where's the evidence? No evidence. Now, in terms of trying to understand, because, so the one thing I will actually credit Van Metre with is he actually forced me to start doing some reading into some subject areas that I wasn't fully across, and to actually correspond with the RBA. And sort of said, well, when you do QE, how does this actually work? Now, if we can put slide 1 on the screen. So I drew this diagram, and basically this diagram is actually in my article. So basically, we've got a 5-step process here. So when the RBA does yield curve control or quantitative easing, and we talked about that difference in our last show, and we won't cover that again. But basically, step one, the RBA will print money, create dollars. It will then buy the bonds from the commercial banks. It will, and that's step two. Step three is it will credit that money in the Australian context, what they call exchange settlement accounts, which is these reserve accounts in the US context. And then basically there's money sitting there. Now, what I had confirmed by the RBA is that when money is credited to the exchange settlement account, this is the property of the bank.
Correct.
So, and the bank has the legal right in the Australian context to take that money and to do three things with it. The banks can settle liabilities with other commercial banks who have exchange settlement accounts with the RBA. If there is a liability that the RBA has to, the banks have to settle with the RBA, it can use money from these exchange settlement accounts to pay their bills with the RBA. The other thing is that when it comes to taxes, it's allowed to take money out of these accounts to pay taxes. So you think that, and to be honest, look, on the tax issue, I was quite surprised because we think about, well, banks pay their fair share of tax. But on the other hand, what I learned in this process is that the RBA can print money out of nothing, put it into an account, and then the banks
can pay tax
in terms of paying tax. So the thing is that, so when you think about it in this context, Martin, well, if the banks actually did that, and I'm sure they have to some degree, well, who's really paying corporate tax in Australia for the banks? It's us through inflation. Correct. because they're creating money out of nothing, and then the banks just take it and give it over to the government.
This is another example of bank keeper, right? I keep coming back to this, right? If you think about everything that the Reserve Bank has done, right, it's all about supporting the banks.
Yes.
Right? This is just one more example. Providing direct liquidity to the banks at very low levels is another example, right? This is all about supporting this whole banking dynamo.
Yes. Now, look, I mean, we didn't rehearse this, but we might as well just put this on the screen. So last year, I had a cartoon commissioned. We talked about it on the show last year. Why don't we actually put that back on the screen for people to have a look at?
Totally relevant.
Indeed, because the title of the cartoon was Communism for the Banks.
Yep.
So basically, we're basically giving the banks all this free money. There's no capitalism. There's no market forces, and then basically using that money to do whatever they want with. And they there is no. There is no market forces in terms of this relationship. It is full communism.
Yep. Now it's all about protecting the banks, and of course the argument is, John, this is for financial stability reasons. That's why they're doing it. Okay. Well, John, you've gone through some of the purposes for which the banks can use the funds. Is there anything else they can use it for?
Yes. When the commercial banks sell their government bonds to the RBA, so that means that the commercial banks have lower holdings of government bonds. When they have access to this money in the exchange settlement account, they can go back to the Treasury and actually use that money to actually buy more bonds. So you have a merry-go-round, and that merry-go-round is how QE actually helps government. Because basically you create money out of nothing, and then, well, who's actually going to participate at the Treasury auctions? It's the banks and the insurance companies who are buying these newly issued bonds. But where are they getting the money from? They're getting it from the central bank, who have just created money out of nothing.
Right, and remember that the APRA structure in terms of the committed liquidity facility is being changed so that effectively they can now hold more government bonds and local authority bonds within their liquidity structures.
Yes.
So it's all being reinforced around the merry-go-round.
Indeed. Now, look, so probably a couple other points to make. One is that, so we covered this in our last show, in that one of the announcements by the Reserve Bank in their extreme policy package from last week was they have set an interest rate on these exchange settlement accounts to zero.
Yep.
So previously, so I think from memory, it was it 0.1 or 0.25?
It was 0.1 last time.
It was 0.1.
Yep.
So when banks had money in these exchange settlement accounts prior to last week, they did get a fraction of interest on it. Now there is no interest.
Yep.
So and the purpose of the RBA putting no interest on these accounts is they want the money draining out of these accounts and back into the economy.
Right. And John, the critical point there is negative interest rates is when they actually take the rate even lower. So the balances at those centralised accounts, the banks get charged for them. Right. That's what's happening in Europe at the moment.
Yes.
That's how negative interest rates drives the banks, in theory, to push more liquidity out into the marketplace, although in practice it doesn't.
Indeed. Now, one of the other points that I flagged in my article that's quite important to note is, so prior to COVID-19 and the lockdown and the stimulus packages, these exchange settlement accounts only had a very small balance of $2 or $3 billion.
Yep.
A couple of months ago, the Deputy Governor of the RBA, Guy Debelle, made a speech in which he said that by mid-year, these exchange settlement accounts had increased in their balances from about 2 to 3 billion all the way up to 90 billion.
Yes.
Now, by September, the balances were back down to 50 billion. So one of the questions I asked in my article is, well, if the balances went up to 90 billion and they reduced to 50 billion, what happened to the 40 billion? And that obviously is what these particular purposes are. That 40 billion has gone back into the economy somehow. So it could be that they have been used to buy more bonds, or they could have been used to pay taxes. Or now, one of the other things that we know is that happened this year is that there was a huge run on cash. Now, when the RBA creates cash, physical cash, and gives it to the banks, so the banks actually have to pay for that cash. So there was about more than $10 billion that was of newly printed cash that was created by the RBA, given to the banks because there was a huge demand for physical cash by the public. So when they received that cash, they had to pay the RBA for that. And I'm assuming part of the 40 billion that was drained out of these accounts, 10 of that was actually paid for this additional cash that was actually handed over to the banks. So they're some of the real factors that have actually played throughout this year. But this example is a clear demonstration of the balances in these accounts can go up when QE happens, but the banks actually have the ability to drain the accounts, and by Van Metre's own admission in this Real Vision finance interview, that's going to create more inflation because the money supply in the real economy, that is actually all going up. And we did mention it in our last show that yes, broad money is growing at the fastest rate since October 2008, and you made the point that credit growth is quite low. So the question obviously then becomes is, well, where is the money going? It's actually going into government balance sheets.
Yep.
And so this is where the federal government, and we talked about that in a previous show about projected cost of COVID about 1.1 trillion, and then you look at some of these state governments, and we talked about South Australia, and Tasmania's projected to have a $1 billion deficit. And then you've got sort of WA and Northern Territory as well. And tomorrow we will see New South Wales. In terms of those deficits, well, all of this money that's going in there is actually fueling a lot of this expansion. And remember, the Keynesian thinking is that if you have a contraction in the private sector and you want to keep aggregate demand at a particular level, how do you do so? The government has to step in. So this additional stimulus is to lift aggregate demand and to stop prices from falling, and obviously in some regards to help prices go up, because as we said in our last show with the RBA, their mission is to support balance sheet and asset prices, and that means basically keep the debt bubble together and keep asset prices either stable or even going up. Okay, Martin. I mean, one final point that I'd just like to make is the RBA about a decade ago, I think about 2011, they wrote a quite comprehensive article about these exchange settlement accounts and what these accounts can be used for. And there's an actual diagram from that article. So let's actually put that diagram on the screen just for people. We're not going to go through this diagram, but basically they sort of give a range of factors as to how can these exchange settlement accounts go up and how these exchange settlement balances can go down. And so the key point of this is there is no evidence that the Van Metre thesis from a legal technical point of view actually operates in Australia. So basically these accounts at the Reserve Bank, they are the money in the accounts is the property of the banks. They can take them out whenever they want. They can put money in these accounts whenever they want. The only restriction from a legal point of view is they cannot overdraw on the account. So if it's 90 billion in the account, you can't take more than 90 billion out. But obviously we have, as we've presented in this discussion, we can show that throughout 2020 the accounts went up and the accounts went down. And why did they go down? It wasn't because of so if there was quantitative tightening, that could be a reason for why the account balances go down. But there hasn't been any of that. The balances have gone down is because the banks have used their money to pay for things, and that's why overall liquidity in the economy and the financial markets have gone up and has not gone down. Now, the question obviously for you is that, so if more liquidity is out in the economy and the financial system, does that mean we see the prices of ordinary things go up at an alarming rate? So far, no. But that secondary part of, well, once the money leaves these accounts and gets into the economy and the financial markets, how does that play in with the broader inflationary situation? That's a separate question, separate to this. And so what I would say is that even though initially Steve Van Metre was talking about America, and then he suggested to a few people this works in Australia, I dare say that the technical explanation I've provided in this conversation about how QE works in Australia is probably pretty much how it's going to work right across the world.
Yeah, John, I think it's very important clarification that you've made there. And in fact, I'll be following up with Steve in a future post, and we'll see, how his thoughts have evolved too. But like I said, let's be very clear, we're not debunking inflation as a potential outcome, right? We're saying that a very specific argument in that overall scheme of things is now being exposed.
Indeed. Now, the important sort of revelation that sort of shocked me in the last fortnight is Steve Van Metre went back on Real Vision Finance, and he gave had a discussion on the 6th of November for more than an hour with a guy called Jeff Schneider. And so I decided to listen to this, and there is a very critical sentence at the specifically at the 17-minute, 15-second mark, in which he conceded that following his interview with Brent Johnson, Brett actually went and spoke to some of the American commercial banks and said, can you use this money in these reserve accounts? And they acknowledged that, yes, once the money is credited in the reserve accounts of the US Federal Reserve, that money can be used to buy new bonds. So the other important point to note is, and I hope you bring this up when you interview Steve, is in his most latest interview, he actually acknowledged that he was technically wrong on this critical point. Yep. So bringing the conversation to a conclusion, I hope our audience can be rest assured that the things that we have been saying to them over the last few years is true. It is well researched. And again, I encourage everyone to do their own homework. If we've got something wrong, I'm happy to be challenged. But when people in the last few months have come to me and said QE is deflationary, and I said, well, where are you getting this information from, Steve Van Metre? Hopefully, through my article and through this conversation, we have debunked that thesis in the Australian context and more broadly in the American context, and that when we say that the RBA is doing more quantitative easing, and obviously part of our discussion last week was not that they had reduced the purchasing of 3-year bonds to 0.1%, but they're going to buy 100 billion of 5 and 10-year bonds over the next 6 months. That's going to have an inflationary impact, because once they buy these bonds, that money that they buy it with has been created out of nothing, and it's going to go flow back into the economy as the commercial banks take that money out of these exchange settlement accounts. So I still am on the inflationary side of the fence, and obviously in our last conversation we referenced the conversation with Peter Schiff, etc. And one of the reasons why I am on the inflationary side is because the through this creating money out of nothing, that money is going back into the financial system, back into the economy, and that will have a more inflationary impact because of what we said in our third program back in 2018, that when you take a fiat currency and you increase its volume, well, that has less value relative to everything else, and that's why the value of currencies go down.
Right, and I would argue, John, maybe, but on the other hand, it does depend what happens to the money. Where does it go? Where does it hit the real economy or not? Or does it get sucked into financial markets or other things where actually it's isolated from the real economy? That actually, for me, is going to be the really important discussion ahead.
Indeed, and we will get into that point because that is a very critical issue, because there are some people, I should say, that are saying that we are starting to see in the real economy things go up. So obviously, if you listen to Christopher Joy, he's saying that property
is going to go up.
Well, not only is it going to go up, that it's already, according to the CoreLogic Index, it's already going up. So some saying that the property sector is on fire. Some people are saying that things like childcare or in terms of food are going up. And it's important to know that in last week when I emailed you and you sent me your latest cost of living index.
Yep.
Even I think when we talked about this last time, 96% of your sample or your population said that the cost of living was higher relative to 12 months ago, where now it's 97%.
Correct.
So you're even saying more people saying the cost of living is getting worse. So that I think is some anecdotal evidence, at least, that all this money printing, all these policies actually is having an impact on the real economy. But the question, I think, in my mind is to what degree? Yeah,
and that's really the point. One of degree, and the second is how long it's going to take, right? Because the other time, if you think about what Schiff said, he said, well, it's going to happen, but not sure when, right? I think that's the other dimension we probably should explore in a future show.
Absolutely.
John, I appreciate your time today. Good research, good analysis, and let's keep talking about inflation or deflation.
Absolutely.
Martin North, John Adams, in the interest of people. We'll see you next time.